Hello and welcome to The Money Show, your one-stop destination for all personal finance queries. I am Snehi Shah. We have lined up a power-packed show for you, wherein first we'll be interacting with the fund manager in our Know Your Fund Manager segment. We have Chirag Dagli, the fund manager at DSP Mutual Fund, joining us to talk about his fund managing style and strategies, the sectors he likes at present, and his management mantras. In the second segment, then, my colleague Kavita will be catching up with Swaroop Mohanty, the CEO at Mirae Asset Global Investments India's. While we will not be addressing any queries today, viewers, you remember to keep writing to us on our WhatsApp number 865-797-4571. You can also email us your queries on the Money Show at etnow.tv. Well, that's that with the show. Let's get kick-started and let's welcome on board Chirag Dagli, the fund manager at DSP Mutual Fund. Chirag, hi, good evening. Thanks so much for joining us on the show. Pleasure to have you on board today with us. Give us a sense of the kind of funds that you are managing right now and what's the total AUM that you manage?
So I run the 3,200 odd crores DSP Healthcare Fund and about 1,800 crores of DSP Multi-Cap Fund. These are the two funds that I run.
Thanks for taking us through that. And also, Chirag, tell us how you would describe your style of management. Are you more growth-oriented? Are you a more value-oriented fund manager?
So the style itself is a blend of both growth and value. It is a very typical bottom-up approach towards stock picking and not have a specific skew towards a particular style, whether it is growth or value, or turnaround, etc. The idea is to have a well-balanced portfolio across these multiple buckets and not get bogged down by labels of growth, value, growth at reasonable price, and so on and so forth. At heart of the strategy is a bottom-up analysis of the companies that we are actually owning.
Point taken. Chirag, help us understand, how would you describe your investment strategy? What are some of the metrics you judge a stock by or a sector by?
Sure. So I think there are only two big drivers for the long term. At heart of the stock picking idea, you want to buy companies which are trading lower than intrinsic value. How do you identify? There are two big matrices that decide what the discounted cash flows of the companies are going to look like 5-10 years down the line. And those two matrices are return on invested capital and the growth that the company has to offer. We are not typically looking for companies that have very high return on invested capital. We're looking for respectable return on invested capital, but also respectable growth. So these are the two matrices that we look at very carefully. Return on invested capital ought to be at least higher than cost of capital, and cost of capital should be in the ballpark of that 10-11% kind of a zone for a typical equity investor. So anything in the zone of high teens for return on invested capital is a good number, and then that's how you think about return on invested capital. And as far as growth is concerned, whatever the company's growth prospects are ought to be justified by the valuations that you are kind of paying for it. So higher the growth, higher the multiple, and so on. But in each of these cases, a respectable return on invested capital is a must. Not very high, not very low.
Okay, understood that. And Chirag, help us understand, how do you assess market conditions when making investment decisions? Because we've just come out of a period of a very sharp correction. We don't even know if we're completely out of the woods yet, but how do you handle periods of market volatility? Because we as individual investors tend to panic when we see our own portfolios. You handle such a hefty AUM. How do you keep calm? What's your strategy of maintaining a level head when the market goes through volatility?
So, that is where understanding of these businesses, understanding of the value of what you own, comes at play. When you own a stock, you behave as a owner of the business and try and think about what this business will look like 5 years, 10 years down the line. And where will the market narrative change? Where the market is today looking at this business in this particular fashion, where will it change 5 years, 10 years down the line? That's how you broadly think about the business, think about the stock and try and assess the value. Sometimes values take time to uncover. Sometimes they will get discovered far sooner than what you originally envisaged. And that is where you kind of play a balance of valuation, and wherever stock prices are far ahead of fundamentals in terms of the opportunities that the company has, you try and sell those and then try and get into other names which are offering better value. So I think rather than worrying too much about the macro in the market, it is more important to worry about what is happening with the businesses that we own. I think that is more important rather than getting too carried away with what's going to happen in the market. Of course, you have some framework to think about macros in the market, but I don't think that is a decider of large part of the portfolio construction that you do.
Okay, Chirag, on that note, also tell us what's your management mantra? What are some principles or fundamentals that you stick by at all times, irrespective of how attractive a stock is looking, or whatever the word on the street is, whatever chatter is roaming around? How do you stick by your principles at all times?
So I think the 2 points that I made, right? Return on capital and the growth that the company has to offer, and sustainable growth, mind you, not really 1, 2, 3 years kind of growth, because 1, 2 years, typically what's going to happen is something which is invariably already known in the market, very well discovered, and very likely in the price. But how do you think about this business 3 year, 5 year, down the line? That I think is very important, to not get carried away by the 1 year, 2 year story, but to think really long term. So that I think is one very important aspect of where sustainable profitability of that particular company business that we own lies, and where are we in that cycle versus the sustainable profitability. So that I think keeps, if you think about it that way, you probably will see through the noise that comes in the market every day. So that's one very important element. The other important element is to think about the point that I made, sustainable return on capital of that business, and that is not defined by just because a company is reporting ROIC doesn't mean that it might have, for all you know, company's profitability is very high, and hence the return on capital is very high. So you have to think about sustainable return on capital of that business and where you are in the cycle versus that return on capital. Again, this element, if you kind of look at it in a lot of detail, granular fashion, you will stay away from a lot of noise that happens in the market.
Okay, and Chirag, let's talk a little bit more about your fund now. You manage the healthcare fund. Now, healthcare is also a very broad term. It's an umbrella term. Tell us, even inside this, amid this healthcare pack, what are the themes that you are liking at the moment?
So like you rightly said, there are multiple themes within healthcare. There's the India formulations business. There is the US generic export space. There is the emerging market export space. There is APIs. There is CDMO. There's diagnostics. There's hospitals. And something that is unique with the DSP Healthcare Fund is we have a global slice, about 15% of the portfolio, where we own companies which are in the medical equipment genomic research space. So a very diversified kind of portfolio. While it is a sectoral fund, but it is a very broad-based sectoral fund, is how I'd like to kind of qualify it. Now within this, I think if you look at valuations, by and large, for the sector as a whole, are I would say fair to slightly lower in some segments. So valuations are fair. From here on, I think compounding is what you would kind of, how you should think about, future gains. The segments that we like within the entire space are things like CDMO, things like, the US generic business, which we still think that, is in a good shape, especially around the core commodity products side. So that's one of the other pieces that we continue to still like. The India business, of course, is evergreen. That again is also something which is expected to grow in double digits for the foreseeable future. So these are some of the things within the entire slice that we kind of like, which is the India business, CDMO, and the US generic on the commodity side.
Lastly, Chirag, before we let you go, just want to get a sense of pharma as a sector. It's been famously known as a defensive sector. We've seen quite the volatility coming in this year. Heading into 2025, do you think pharma is going to be the bet that's going to really show up?
See, I think selectively we have lots of ideas within healthcare that we continue to own. As DSP, we are by and large overweight on healthcare as a sector across all of our diversified funds, including the multi-cap fund, which I individually run. That also we are overweight on the healthcare sector. So difficult to generalize for the sector as a whole, but I think within the sector, there are enough ideas which lead us to believe that there's a good story here to kind of play for the next 2 to 3 years.
Chirag, on that note, we'll let you go. Thanks so much for taking the time out, joining us on the Money Show and speaking to us here at ET Now. But on that note, viewers, time to slip into a quick break on this edition of the Money Show. On the other side, Kavita will be catching.
If you like this video, then like, share and subscribe to ET Now.